Hello everyone, this is Dave, aka DREBG, senior member over at informedtrades.com. For those of you not familiar with Informed Trades, I welcome you to go on over, poke around a little bit, see all the free information they have there, especially the university with lots of free trading videos and advice, as well as some great traders and forums that you can participate in. Today is January 17th, Martin Luther King Day, 2011, and I'm going to go over some divergence trades that I was playing with last week and thought I'd make a video of. This is specifically going to be dealing with the Euro-Aussie. What you're looking at is simple price action on the 4-hour chart for the Euro-Aussie, and as you can see, things have been kind of moseying themselves along in a range that hasn't really found its way yet. Although the major trend seems to be down, it also seems to maybe possibly be breaking to the upside. I'm going to go through how it is I set up my trades, how I set up my charts, how I mark them up, so that I can identify those high probability setups. First thing I do is I like to put in some moving averages. As many of you may know, I'm pretty partial to using the 200 EMA as a primary determinant of trend, and then I use the 8 EMA, which is the yellow line, and the 20 EMA as a midline. These just help me give some structure and get an idea of when trends may be changing or moving. And ultimately, it just allows us to have a little more structure to price action alone. The next thing I like to put up are some supply and demand areas, or support and resistance lines. You can see that I've put them in pretty basic places where anyone could look at the screen and go, yeah, I think that's a place where price action paused for a little bit. Or here, where we have some touches here and here and here. Or likewise at the very bottom where this yellow line is, where simply is the very bottom of where price action was recently relative to this 4-hour chart. There's another big time frame up here that I have in blue, but for the most part we're really concerned about these red areas for support and resistance. Now support and resistance is really important because it allows us to see where price action may be doing something next. What's the next big thing? And then when we get around those areas, we then want to see what price action is doing in terms of whether it wants to continue through those support and resistance areas or maybe turn around and retreat. Now what I like to use in determining what price action might do around those support and resistance areas is to put an indicator on. Now in this case, I'm going to put up the CCI. This is a 10-period CCI. There's no big secret. You can use whichever indicator you wish, MACD, stochastics, RSI. One of the things that you'll notice that I've put on here are these lines. One is going to be the negative 100 level, the other is the positive 100 level. And I've also added the negative 200 level down here and the positive 200 level up here. Now this is important because that's really the only areas that I really care about, these areas in here. And if I were to mark them off, they'd look something like this. I want to see where price action is relative to this indicator when it is in this oversold area, i.e. maybe going up by green, or overbought area, which is up here, red, potentially looking to sell. Really, those are the areas where divergence is most prevalent. And then the next thing we try and do is find when divergence occurs inside of these zones. Let's do a little bit of middle chart trading, meaning this has already happened and we can help identify what those areas are for the future of what may happen given the same circumstances that happened in the past. Right chart trading, obviously, over here is where we have to trade and we can't do anything else but this middle chart trading at least gives us some idea of how to maybe analyze our setups so that when we are right side trading we can actually find them. This is our first set of divergence where we have price action going up and divergence going down, but it's inside this overbought area, meaning divergence happens and it is most indicative of what may happen when it's in overbought or oversold territory. Here we have clear divergence on a 4-hour chart, and again longer time frames are typically much more accurate. The idea here is I would look to see when it crossed down through the 100 level, and that candle would be this red one right here. I would then enter on the close of that red candle. Notice how the following candle retraced back up roughly halfway and came down and continued. So it would be somewhere in here and it would take you into the trade as price action moved down, thus lowering your risk. Let's look at another one. The divergence occurred right around this supply and demand area, or support and resistance area, and when it came up and we saw the divergence and it was negative divergence, that would mean that the next area where something would happen, i.e. support and resistance area, when price action reaches that, it's going to do one of three things. It's going to blow through it, it's going to retrace back, or it's going to go into some sort of a range. In this case, the divergence lets us know that there's a good high probability that it's going to retreat probably back down to the next supply and demand area. Let's look at another one. This encompasses divergence with 2 points in it. You can see the old ones had 1 point each. 1 point each. This one now has 2 points where price action had changed direction. Now in this case we didn't quite reach up around this support and resistance area, but we certainly can see that with that steepness and this big run up here that perhaps we're having some exhaustion before anything else really big happens. So the idea would be here to enter where price action goes below the 100. It is not to say we enter right after the peaks happen. We need to give it some time to breathe, and here's why. If you entered right here, we have this run up here that went up to the 200 EMA almost, and then started to retreat. By waiting for it to go below the 100, we are able to avoid a lot of this mess. And in fact, we see this pin bar set up, and this is actually where it goes below 100. So we would enter a sell on stop order that would go down and pick up our order as price action, you can see here, retraced roughly halfway up this previous candle, and it will pick us up in going down, and then we are in the trade. Our stop would be above that swing high, and our target would be somewhere around this support and resistance area, although with a bigger type of divergence you'd expect it to have a little more movement, and perhaps set this up as your target. Let's take a look at another one. Here we have the opposite. This is positive divergence, where we have these peaks that match up with one another on the CCI as well as price action, and then the other end marks itself at the peaks here. Again, we're waiting for CCI to go above negative 100 before we think about entering. If we entered here, we see a little bit of a retracement back down before it starts to commit itself and go back up. If we wait until we're at the negative 100 level, we're at this candle here, and again we have a little bit of a retracement before this large green candle kicks in. We would put a buy stop order to pick us up on the way through, either on the high of this candle or the close of this candle. This picks us up and gets us back in to either this support and resistance area, although the risk to reward may not be quite enough because we would put our stop here. So we would be actually looking for a target of this support and resistance area. How about one more? We're now back at the top of this range, if you will, on CCI. We've also reached the top again here on price action. Now, I have to mention, this is where moving averages could come into play. You see how we've had a cross prior to this divergence? We had another cross prior to divergence here. We need to be sensitive to the fact that when we see those moving averages moving upwards, we may be looking at a trend change. You can see here we've been in a pretty steady downtrend, and the 200 EMA is helping us identify that. But in fact, when this divergence happens, we need to be careful about where our target might be. Now that they've crossed, it's not always a foregone conclusion it's going to reach down to that next support and resistance level. We need to be respectful of that and put our targets accordingly. In this case, it would be a very shallow stop and then of course a very short target. So with that, I hope you've gotten a little bit out of it. It's interesting how charts can go from this to simply adding a few bits of structure that allow us to start to see what we might want to be looking at when we actually look for high probability trades. And it's amazing when you put it all together that you can actually see them start to form. And as usual, if you have any questions or concerns, you can meet me over at informedtrades.com, or you can email me at drebg@yahoo.com.